Investment strategies for extremely volatile markets. Most investors are aware that the market undergoes a period of both bull runs and downturns. So, what happened during the period of extreme market volatility? Making the wrong moves could wipe out previous gain and more. But using either a non-direction or probability-based trading method, investors may be able to protect their asset from potential losses and may be able to protect from the rising volatility using certain strategies. In a financial market, volatility refers to the presence of extreme and rapid price swings. Given increasingly a volatility, the possibility of losing some or all of an investment is known as risk. Direction investment strategy. A strategy practiced by the most private investors requires the market to move consistently in the desired direction. On the other hand, non-directional investing take advantage of the market inefficiency and in relative pricing discrepancies. Volatility allows the investor to reconsider their investment strategies. So, what's the difference between volatility and risk? It is important to understand the difference between the volatility and the risk before deciding on a trading method. Volatility in finance market is a quantification of the speed and the magnitude of an asset pricing swing. An asset that sees its market price more over time has some more of a level of volatility. The greater the volatility, the larger and more frequent these swings are. Risk, on the other hand, is possibility to lose some or all of the investment. There are several type of risks that can lead to the potential loss, including market risk. This price will move against you. As the volatility of the market increases, market risk also tends to increase. In response, there can be marked increase in the volume of traders during these periods and a corresponding decrease in the holding period of position. In addition, hypersensitivity to news is often reflected in the prices during the time of extreme volatility as the market overreacts. This increased volatility can correspond with larger and more frequent downswing with the present market risk of investors. Likely volatility can be hedged away to some degree. Moreover, there are ways to actually profit directional from volatility increases. Hedging against volatility. Perhaps the most important thing for the most long-term investor is to hedge against downside losses when market run volatile. One way to do this, of course, is to sell shares or set stop loss order to uh, automatically sell them when price fall by a certain amount. This, however, can create a taxable event and moreover remove the investment from one's portfolio for buy and hold investment. This is often not the best course of action. Instead, investors can buy protective put action on the other single stock they hold or on a broader index such as S&P 500. A put option gives the holder the right to sell the share of the underlying asset price on the before the contract expires. Say that XYZ stock is trading at $100 per share. You wish to protect against losses beyond 20%. You can buy 80% strikes put, with which grants the right to sell share 80% $80 even if the market falls. So say that $50. This effectively set a price floor. Note that if the stock never falls to the strike price by its expectation, it will simply expire worthless and would and you would lose the premium paid for the put.